Imagine waking up one morning and watching your investment drop by thousands of dollars in minutes. You had been holding Bitcoin for months, maybe even years. You believed in it, you trusted it, and then the market forced you out. Right at $63,000, millions of people sold their Bitcoin. They panicked, they gave up, and they walked away from what would become one of the biggest pumps in crypto history. What happened next left those investors speechless and frustrated. And the craziest part is that this was not random. This was not bad luck. There was a very specific, very calculated mechanism behind it. And if you stay with me today, you're going to understand exactly how Bitcoin forced millions of people to sell at the wrong time, right before it exploded higher. This is one of the most important stories in the history of Bitcoin, and most people have never heard it told this way. So stick around, because what you are about to learn could change how you think about investing forever. Welcome back to Money Finance Insights, the channel where we break down complex financial events into stories that actually make sense. If this is your first time here, do yourself a favor and hit that subscribe button right now. We post content like this regularly, and you do not want to miss the next one. And if you find value in today's video, smash that like button because it truly helps us reach more people who need to hear this. Now let us get into the story, because this one is something else. To understand what happened at $63,000, we need to go back and set the scene. Bitcoin had been on an incredible run in 2024. After years of suffering through a brutal bear market, crypto investors were finally seeing the light again. The approval of Bitcoin spot ETFs in the United States had injected fresh excitement and fresh money into the market. Big institutions were buying, everyday investors were buying, and the price was climbing fast. Bitcoin broke past 50,000 for the first time in over 2 years. Then it crossed 60,000, and the excitement was electric. Everyone was talking about Bitcoin hitting a new all-time high. Social media was flooded with predictions of $100,000 and beyond. It felt like nothing could stop it. But then, something strange started happening around the $63,000 zone. The price started stalling. It would push up towards 63,000, almost touch it, and then get slapped back down. This happened not once, not twice, but multiple times over several weeks. And every time it failed to break through, more and more people started getting nervous. Now here is where the story gets really interesting. Most regular investors looked at this and thought the market was just running out of steam. They thought buyers were tired and that maybe Bitcoin needed to cool off. But what was actually happening was something much more mechanical, much more deliberate, and much more fascinating. The $63,000 level was what traders call a major resistance zone. This means it was a price level where an enormous amount of selling pressure was waiting. Think of it like a dam holding back water. The water keeps pushing against the dam, but the dam holds firm until it doesn't. But there was something else happening underneath the surface that most people never see. There was a massive pool of leveraged long positions sitting just below $63,000. Now, if you are not familiar with leverage trading, let me explain it simply. When a trader opens a leveraged long position, they are essentially borrowing money to bet that the price will go up. If they borrow at 10 times leverage and the price moves up 10%, they double their money. Sounds amazing, right? But here is the brutal other side of that equation. If the price moves down even just a small amount, the exchange automatically closes their position to prevent further losses. This is called a liquidation. And when a position gets liquidated, it means that Bitcoin gets sold automatically by the exchange. One liquidation alone is not a big deal. But when you have billions of dollars worth of leveraged positions stacked up at similar price levels, something terrifying happens. It creates what traders call a liquidation cascade. Here is how a liquidation cascade works and why it is so destructive. Imagine Bitcoin is trading at $62,500. There are thousands of traders who opened leveraged long positions at various prices between $50,000 and $62,000. Many of them are using 5 to 10 times leverage. Their liquidation prices are set just below the current market price. Now the price starts to fall slightly. Maybe it drops to $61,000. Some of the more aggressive traders get liquidated first. Their Bitcoin gets automatically sold. That selling pushes the price down a little more. Now more liquidation levels get triggered. More automatic selling hits the market. The price drops further. Even more liquidations get triggered. And so the cycle continues, each wave of selling feeding the next one. This is the cascade, and it can happen with frightening speed. We are talking about billions of dollars being wiped out in minutes. This is exactly what happened around that $63,000 zone. Data from major crypto exchanges showed that there were over $2 billion in leveraged long positions sitting in a narrow price band. When Bitcoin started falling from that resistance zone, it did not just fall gently. It triggered a chain reaction that forced millions of traders and investors out of their positions, whether they wanted to sell or not. Some of these people were not even using leverage themselves. They had bought Bitcoin directly, holding it in their own accounts. But the fear created by the sudden price drop caused them to panic and sell manually. Human psychology kicked in. The voice in their head said, "This is the top. Get out now. You're going to lose everything." And so they sold, right at 63,000 or even lower as the cascade accelerated downward. Now here is the part that makes this story truly heartbreaking for those who sold. Within weeks of that major flush out, Bitcoin did something nobody who had just panic sold expected. It came back, not just back to 63,000. It smashed through it like the resistance was never even there. It blew past 65,000, 70,000, 75,000. Eventually, Bitcoin reached a new all-time high above $73,000 in March of 2024. And then later that year, it continued climbing, ultimately breaking through the magical $100,000 milestone. The people who sold at 63,000 had locked in their losses or their missed gains. They watched from the sidelines as the asset they believed in, enough to hold for months or years, went on to do exactly what they had originally hoped. So why does this keep happening? Why do so many smart people, well-intentioned investors, people who had done their research, why do they keep getting shaken out right before the big move? The answer lies in a combination of market structure, human psychology, and something called smart money behavior. And understanding this will genuinely change the way you look at any financial market. Let us start with market structure. Every financial market, whether it is stocks, real estate, gold, or Bitcoin, has what are called areas of interest. These are price levels where large amounts of orders are sitting. Some of these are buy orders, some are sell orders, and some are stop losses set by traders. Stop losses are automatic sell orders that investors place to protect themselves. They say, if the price drops to this level, automatically sell my position so I do not lose more than I'm comfortable with. This sounds smart, and in many cases it is. But here's the dark irony. Stop losses can actually be used against you. Large institutional players, the hedge funds, the market makers, the whales who move billions of dollars, they can see roughly where the clusters of stop losses are sitting. Not precisely, but through experience and data, they have a very good idea. And sometimes those large players will push the price down deliberately into those stop loss zones. This forces the small traders and retail investors to sell their positions automatically. The institutions then scoop up that Bitcoin at a discount. And once they have accumulated what they want, they allow the price to rise, often rapidly and dramatically. This strategy is sometimes called a stop loss hunt or a liquidity sweep. It sounds cynical, and it is, but it is also a fundamental part of how markets work. And it has been happening in every asset class for as long as markets have existed. Now you might be wondering, is this legal? Is this manipulation? The honest answer is that it exists in a gray area. In traditional stock markets, certain forms of this activity can be illegal, but in the crypto market, which is largely unregulated, these practices happen openly and regularly. This is one of the reasons why experienced traders always warn new investors to be careful with stop losses. Placing your stop loss at an obvious level is like leaving your wallet on a park bench. Someone is eventually going to take it. Let us talk about the psychology side of this, because this is just as important as the mechanics. When Bitcoin was hovering around 63,000 and repeatedly failing to break higher, something was happening in the minds of investors. Doubt was creeping in. The headlines started shifting. Media outlets that had been bullish a few weeks earlier started publishing stories about Bitcoin losing momentum. Analysts who had called for higher prices started hedging their predictions. Social media sentiment shifted from greedy excitement to cautious uncertainty. And this matters enormously because in financial markets, sentiment drives behavior just as much as fundamentals do. There is a famous concept in behavioral finance called loss aversion. Research by psychologists Daniel Kahneman and Amos Tversky showed that people feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equivalent gain. In simple terms, losing $1,000 hurts about twice as much as gaining $1,000 feels good. This creates a powerful psychological bias. When an investment starts going down, the emotional pressure to sell becomes overwhelming. Even if your logical brain knows that Bitcoin has a strong long-term case, your emotional brain is screaming at you to stop the pain. And that is exactly the environment that existed at $63,000. The price was stalling, doubt was growing, and the emotional pressure to sell was enormous. When the cascade started and prices dropped quickly, millions of investors experienced that emotional overwhelm simultaneously, and they sold. There's another psychological trap that played a massive role here, and it is called recency bias. Recency bias is the human tendency to overweight what has happened recently when making decisions about the future. When Bitcoin had been falling or stalling for weeks, investors began to assume that the recent downward or sideways movement was the new normal. They forgot about the dozens of times in Bitcoin's history when it had done exactly this, shaken out weak hands, and then surged to new highs. History was repeating itself. But because of recency bias, millions of investors could not see it clearly enough to hold on. Now let us bring in one more layer of this story because it is absolutely critical. It involves the concept of Bitcoin halving cycles. If you are not familiar with the Bitcoin halving, here is the simple version. Approximately every 4 years, the reward that Bitcoin miners receive for processing transactions is cut in half. This is built directly into Bitcoin's code by its creator, Satoshi Nakamoto. It is designed to control the supply of new Bitcoin entering the market. When miners receive less Bitcoin as a reward, the rate of new supply slows down. If demand stays the same or grows, basic economics tells us that a tighter supply should push prices higher over time. Every single halving event in Bitcoin's history has been followed by a significant price increase within the following 12 to 18 months. The 2012 halving was followed by a price explosion from around $12 to over $1,000. The 2016 halving preceded a rise from around $600 to nearly $20,000 by the end of 2017. The 2020 halving preceded a run from around $8,000 to nearly $65,000 by early 2021. And then came the 2024 halving, which occurred in April of that year. The Bitcoin price at the time of the halving was right around the $63,000 zone. This is not a coincidence. This convergence of the halving event with the major resistance zone and the liquidation cascade created a perfect storm. Think about what that meant for the investors who sold at $63,000 right around the halving. They sold at a historically significant moment. They sold at the exact same price level that has preceded explosive upward moves every single cycle. And they sold because of fear, leverage, and market mechanics that most of them did not even know existed. It is genuinely one of the most painful examples of how the financial system can work against the average person. But here is what makes the Money Finance Insights community different. We talk about these things openly. We break down the mechanics so that you understand what is really happening. Because knowledge is the only true protection against being caught on the wrong side of these moves. When you understand how liquidation cascades work, you think twice before using excessive leverage. When you understand stop-loss hunts, you think more carefully about where you place your stops, if you use them at all. When you understand market psychology and recency bias, you become a little bit more immune to the fear and panic that gets injected into markets during these moments. None of this makes you bulletproof, but it makes you significantly more prepared than the millions of people who sell at 63,000 and then watch Bitcoin hit 100,000. So what can you actually do with this information going forward? Let us talk about some practical takeaways from this story, because understanding it intellectually is one thing. Being able to apply it during your next investment decision is something else entirely. First, be extremely careful with leverage. The allure of multiplying your gains is powerful. But leverage is a tool that very consistently destroys retail investors in moments exactly like the one we described today. Professional traders who use leverage do so with sophisticated risk management systems, strict position sizing, and years of experience. Most individual investors do not have those systems in place, and the exchanges offering you 20 times leverage are not doing it because they want you to win. They profit from liquidations. Keep that in mind. Second, understand the concept of where you are in a market cycle. The halving cycle in Bitcoin is one of the most reliable macro patterns that exists in any financial asset. That does not mean it will repeat perfectly every time. But understanding that you are in a historically bullish part of a 4-year cycle is important context. It means that dips, even sharp and scary ones, are more likely to be buying opportunities than the beginning of a permanent collapse. Context changes everything. Third, have a plan before you invest, not during the panic. Write down your investment thesis. Write down what would actually change that thesis. Write down the price level at which you would accept that you were wrong, and then commit to that plan. Because when the price is dropping fast and the headlines are screaming, you will not be able to think clearly enough to make a good decision in real time. The plan you make in a calm moment is almost always better than the decision you make in a panic. Fourth, size your positions for survivability. If a 50% price drop would force you to sell because you cannot emotionally or financially withstand seeing your investment cut in half, then you are sized too large. Bitcoin and crypto markets are famous for their volatility. The stories of 100% gains are always accompanied by stories of 70% drops. If you invest only what you can genuinely afford to hold through a rough patch, you dramatically increase your chances of being there when the recovery happens. Now, let us zoom out and look at the bigger picture of what this story tells us about financial markets in general. Because the Bitcoin 63,000 story is not unique to crypto. Similar dynamics play out in the stock market, in the commodity markets, in real estate. Anywhere there is leverage, fear, and large institutional players, you will find versions of this same pattern. The details change, the asset class changes, but the human psychology does not change. And the market mechanics do not fundamentally change either. This is why financial education is so genuinely powerful, not because it lets you predict the future, but because it lets you recognize patterns and protect yourself from the most common traps. Think about the millions of people who sold Bitcoin at 63,000. Many of them were not stupid. Many of them were not even making an emotional decision in the moment. Some of them were following rules they had been taught. Use stop losses to protect yourself. Do not be greedy. Take some profits on the way up. These are not bad rules in isolation. But in the context of a liquidation cascade triggered right at a major resistance zone, right around a halving event, those rules became exactly the mechanism that transferred their Bitcoin into the hands of people with deeper pockets and longer time horizons. This is why context matters so much in finance. Rules without context are just instructions. Understanding is what turns rules into wisdom, and wisdom is what separates the investors who hold through the storm from the ones who sell at the bottom of it. Here's another thing worth mentioning about the 63,000 story. The aftermath created something important for the market long term. When all of those weak hands were shaken out, when all of the over-leveraged positions were liquidated, the market was cleansed. The sellers who were going to sell had sold. The people who remained as holders were the true believers, the long-term investors, the institutions with multi-year mandates. This is what traders call a healthy flush. After a major liquidation event, the market often becomes more stable and more capable of making sustained moves higher. The reason is simple. With the weak hands gone, there is less potential selling pressure overhead. The market can breathe. And then the buyers come back in step by step, and the price begins its recovery. This is exactly what happened after the Bitcoin flush at 63,000. The price did not immediately rocket upward. It stabilized, consolidated, built a base, and then the buyers slowly got more aggressive. The institutions that had been watching from the sidelines saw the dip as the entry point they had been waiting for. The retail investors who understood the halving cycle saw it as a gift, and gradually, then suddenly, Bitcoin broke through 63,000 like it was nothing. The resistance that had held for weeks crumbled in a single candle, and the people on the right side of that move made extraordinary returns. Before we close out today's video, I want to address one more thing, and that is the emotional side of being an investor who went through this experience. If you are someone who sold Bitcoin around 63,000 and watched it go to 100,000, I want to say something directly to you. You are not stupid. You are not a failure. You made a decision based on the information and the emotional state you had at the time. Every single person who has ever invested in anything has made a decision they later wished they could take back. The legendary investor Warren Buffett has said publicly that he regrets not buying Amazon much earlier. He missed one of the greatest stock runs in history, and he is arguably the greatest investor who has ever lived. Making a mistake does not define your investing future. What defines it is whether you learn from the experience, whether you use it to sharpen your understanding and improve your approach going forward. The knowledge you picked up in this video today is more valuable than any single trade, because it will apply not just to Bitcoin, not just to crypto, but to every financial decision you make for the rest of your life. And this brings me to the most important point of everything we talked about today. Financial education is not optional in the world we live in. The system is designed in ways that favor those who understand it, not because there is some shadowy conspiracy against average people, though bad actors certainly exist, but simply because markets are complex, psychology is exploitable, and information is not evenly distributed. Every video you watch here at Money Finance Insights, every concept you take time to genuinely understand, is an investment in your own financial literacy. And that investment compounds just like money does. The more you understand, the better decisions you make. The better decisions you make, the better outcomes you experience. And the better outcomes you experience, the more confident and capable you become. That is a positive cycle worth starting. Now, here is what I want to ask of you before you leave today. Drop a comment below and tell me this. Were you in the market during the Bitcoin 63,000 moment? Did you hold or did you sell? No judgment at all. This is a safe space to share your experience. And if you were not in the market, tell me what you would have done. Would you have held through the drop or taken the loss? Let us have that conversation in the comments, because the experiences people share here genuinely help others learn. Your story might be exactly what someone else needs to hear today. Also, if you found today's video valuable, please share it. Send it to a friend who is interested in crypto or investing, post it in a group chat, share it on social media. These kinds of videos reach the people who need them most when real viewers share them. And when you share, you are not just helping us grow, you are genuinely helping someone else avoid a painful financial mistake. That matters. And finally, if you have not already subscribed to Money Finance Insights, now is the moment. We do deep dives like this regularly. We cover stocks, crypto, economic trends, and financial psychology, all explained in the same straightforward, story-driven style you got today. Hit subscribe and turn on notifications so you never miss a video. Because the next story we tell might be the one that saves you from your own $63,000 moment. Thank you for watching all the way through today. That means a lot, seriously. The Bitcoin 63,000 story is one of those events that reveals so much about how markets really work beneath the surface. The liquidation cascades, the stop-loss hunts, the psychology of panic, the halving cycle, all of it coming together in one brutal and beautiful moment. Markets are not random. They follow patterns, they exploit psychology, and they reward the patient and the prepared. The fact that you are here, watching, learning, and thinking about these things puts you ahead of the vast majority of people who invest, without ever trying to understand the game they are playing. Keep that curiosity alive. Keep asking questions. Keep learning. Because in the long run, the investor who understands what is happening almost always outlasts the one who is just along for the ride. We will see you in the next one.